Is your 401k ready for a 10% drop? With no major market pullback in the last 4 years, the big question at hand for a lot of Americans, Abe, is have we gotten too lazy? Are we too relaxed when it comes to our precious, most prized possession? I mean, for most people, their retirement nest egg is the greatest amount of wealth that they will ever have. And
Sure.
we've gotten spoiled by this market. So that's what I want to talk to you about. Glad to have you here with us on the Retirement Key with Abe Abish, financial advisor, founder of Abish Financial Services, here to share his insight on things he wants to make sure that you know about. 401k is obviously one of the biggest retirement saving tools in the United States. Okay, this is where my financial education runs short. Is a 401k, is that an international savings tool, or is that an American only?
Good question. I think it's mostly here domestic in the States, but I know other countries have their versions of it.
Have their versions of it.
Yeah.
Okay.
Yeah.
And obviously in the DC metro area, with all the federal government workers, we have things like TSPs. A lot of independent savers have their own IRAs, but all in all,
school systems will have 403Bs. State employees will have 457. It's really the same type of plan. They're just numbered differently.
That's right. Okay. So it's just different ways to save, but we are market invested. And if you were to look at your balance in your 401k and just go ahead and subtract 10%, you probably are not going to feel very good. It doesn't feel good to see things like that, but it is in fact a normal occurrence in the stock market. On average, it happens once a year. However, it's been over 300 days since the last one. We haven't had a significant pullback in the market in over 4 years. 2008 is now 17 years behind us in the rearview mirror. So what are your thoughts? I mean, do you feel that people are getting too lazy? Are we complacent when it comes to protecting our money?
I feel like people are starting to realize that this 17-year bull run, 17-year bull run, other than 2022, could be coming to an end soon. I mean, it's been on such a hot run. If you look at the average annual returns going back to 2009, Heather, I think since in the S&P 500, I think we're talking about like 15% per year, average annual returns. That's not normal.
Right.
You know, maybe you would expect to make 8 or 9% on average per year in the markets the rest of your life, but 15 per year, the last, 16 years is just on fire. And it's been great for everybody. And that's what's helped a lot of Americans get to the point where they can actually retire.
Yeah.
And I love seeing my accounts go up. I love seeing our clients' accounts go up. That's all great. But it does, I think it's causing me a little bit of concern. And I think our firm, because at what point is this party going to end or maybe slow down?
Well,
Correct.
it's your literal job to be looking for indicators of what's going to happen with the market and to work to help protect the people that have come to you with their retirement money. So, of course, I would have to imagine that you're a little bit more on edge than anybody because you have to be looking for indicators.
Yeah. And I think here over the last several months, interest rates and inflation have been probably the biggest story, other than, newer administration and just, tariffs and things going on in the government. I think those can spook the markets from time to time. But probably the biggest story long term is going to be what's going to happen with inflation and interest rates. And, we had 3 rate cuts in 2024 for the first time in 4.5 years when rates rose 11 times. We were expecting and anticipating, or the markets were, 3 more rate cuts in 2025. Now it looks like we might only get 1. And in fact, the Federal Reserve said there's a chance that we would have to increase rates because inflation is still that sticky.
Yep.
If that happens, you can almost guarantee that the markets, there's no guarantees when it comes to the markets, but it's probably going to be pretty certain that the markets would turn around and go backwards. I mean, look what happened in 2022. Rates rose 7 times. The S&P lost 20%.
Yep.
So when rates rise, I mean, think about it. If you can then go back to Bank of America or your bank and make 5% again on a CD, 5% on a money market or whatever, that we could get a while ago. Now these rates are down into the 4s. That's going to give some people some pause. Like, I mean, why put all my money in the market if I can get 5% somewhere that's safe and secure?
Right.
And so the markets don't like rising rates. They like lower rates, which is why the markets were really on fire and did so well from 2009 to really now.
Yeah.
When I think about retirement and I think about one of the biggest risks, if not the biggest risk that can affect someone's wealth long-term, someone's retirement, someone's happiness, someone's ability to achieve all their goals and objectives in retirement, it's certainly protecting your life savings from a market crash, from significant market loss. In fact, when we're in our meetings with clients, with most of our clients, we'll say one of the biggest things you can do, Heather, to secure your retirement is to avoid large loss. What's a large loss? Usually a negative 20 or greater, because usually a negative 20 takes 3 or 4 years to recover from.
Okay.
Well, if you're sitting here at the point of retirement or just into retirement, you're telling me you need income from your portfolio, and then your portfolio is backwards by negative 20.
Yeah.
Or God forbid, negative 30, 40, or 50. And then you got to get your hands in the portfolio for income on top of it. It could really be a stressful, unpleasant situation that forces you back to work or changes your lifestyle, either temporarily or permanently. So if you're getting close to the point where you have enough money saved to retire with dignity and confidence, or have already saved enough, we meet with so many people, Heather, that have already saved enough, then man, consider taking some chips off the table. You know, one couple we had talked about previously that we just worked with, just came on board, has $6 million. And about $2 million of their portfolio is what they need for income. The other $4 million is icing on the cake.
Right.
They were at 90% in stocks. We recommended coming down to a 70-30.
Okay.
Why? Because a third of their portfolio accomplishes their income needs in retirement. Man, that's fantastic. So don't continue investing like you're 40 or 45 if you're now 60. If you've won the game, you have enough saved to retire successfully. Don't take on any extra risk.
Right.
Taking on extra risk to what end, to what cause, for what purpose, that's where you can really get burned.
Okay.
And so if you look at some of the most successful investors of all time, I mean, look at what Warren Buffett is continuing to do. He and Berkshire Hathaway are continuing to raise cash, continuing to plow money into U.S. treasuries and safety cushions so that if and when the markets do turn around, you know, and treasuries right now are paying a little over 4%. So it's not the worst place to have a little bit of money, but they're raising significant cash, putting them into short-term government U.S. treasuries. Those might be signs that we should look at. You know, hey, if Warren Buffett and Berkshire Hathaway are taking some chips off the table, reducing positions in companies like Apple and Nvidia, taking some chips off the table, pulling in the reins a little bit, maybe we should as well. And so I think that's a really important thing for people to consider as they get close to retirement. You mentioned 401k balances, now subtract 10. Hey, a 10% loss wouldn't be so bad. It'd be healthy and normal. I think what we really need to look out for is a negative 20 to a negative 40. Man, I hope that doesn't come again. But if it does,
it's the market. I mean, it's part of being.
It happened in 2008. I mean, who knows? Who knows?
Nobody
knows.
Certainly
could certainly happen again. You go back to the early 2000s, we had 3 down years in a row that caused a negative 46. That was the tech bubble, the tech boom and bust. I had a buddy back then I played competitive baseball with, because I played in college and then competitively in the area in my early to mid 20s. And he worked for AOL at the time. And he was a senior arts and graphics designer for AOL. He was 30 years old, worth $6 million. No, he was 30, worth $6 million in AOL stock. He helped design the AOL logo. Ferrari, Porsche 911, a couple houses. He lost everything, Heather, except for $400,000. He lost $5.4 million in stock because he held. I mean, you know, AOL was the king of the world back then. They were the world's leading internet provider. Yeah. I probably would have drank the Kool-Aid too, but there were people that made a ton during that tech boom and bust and people that lost a ton. Companies here and locally on the toll road that were born in a day, gone in a day, just like that. Yeah. You have companies like the Lehman Brothers and what's the other company? Lehman Brothers and one other company these are like kings of the world at the time that just disappeared instantly when crashes happen. So we've got to be prepared, and putting together a retirement plan that proactively gets us out in front of those ups and downs, because we know they're going to happen. Don't wait until it's too late. Don't wait until the market starts to slip to put a plan together. Put a proactive plan together in place now. Now is the best time to do it, because markets have pretty much hit all-time highs again. Your retirement values are probably at all-time highs as well. There might not be a better time in the very near future to do it than to do it now.
Got it. And to the point you were making about this one couple, you said they had $6 million saved, and it's not, they had a kind of a 90-10 ratio with their investments. 90% was in the market and another 10%. Okay. But you talked about what they needed for income was $2 million. So perhaps for somebody who's listening to you and heard that AOL story and is sick about the idea that maybe they have $5 or $6 million and God forbid they lose this money like your friend did, but in their retirement, and they're like, okay, I want to not do that.
Sure.
Does it start then with that conversation of, all right, we need this much money to do income? And we protect that
That's
money.
right.
That's right. Step number one, right?
That's right. Yeah. 30 years old is one thing that, you know, my buddy had 30, 35 years in front of him to get to 60. You're 65 and that happens, look out.
Yeah.
Yes. To answer your question, that's exactly what we do. We look at the whole plan, all of the assets, all of the income sources. And the first thing we do, Heather, is we get all that information up on a huge TV screen and we look at a cash flow and income projection to see how far does your Social Security, your pensions, annuities, rental income get you? How far does it take you? And do you have a surplus? Does that income exceed your expenses, or is it short of your expenses?
Okay.
And if it's short, like this couple with $6 million, we found out that, well, you do need part of your portfolio to generate income for you to sit on top of Social Security and pension.
Yeah.
And that was about $2 million. But this additional $4 million that you have accumulated as well, that's certainly going to be your growth bucket, because you don't need income from the growth bucket.
Got it.
Any income that can come from that growth bucket is just, again, additional icing on the cake.
Right, right.
You want to take that really, really nice trip to Italy. You want to fly first class. You want to do it right and stay at the Four Seasons and all this stuff.
Yeah.
That's where you'll be able to do it from, that part of the portfolio.
Okay.
Right. But 30% of the portfolio on top of Social Security and pension is going to cover that foundational income you need coming in no matter what the stock market does. I mean, I have to say that's a really good place for a retiree to be. If you can accomplish your income objectives with just 30% of your savings.
Yes.
And the other 70% is just sitting there for long-term growth. Man, that's a fantastic way to put together a retirement plan. And that's exactly what they did.
Okay. Thinking about then for folks that are wanting to know other things they need to do as far as creating more security. Maybe they have felt good about their market growth, but as you get into your late 50s, early 60s, you're realizing, all right, now I need to start thinking about more about protection and income. That's what you always tout, right? During your working years, you think about growth. During your retirement years, you got to focus on protection and income.
That's right.
So how do, besides focusing on our income and then calling out what we need to ensure is as safe as it possibly can be, and then going from there, what are our options when seeking out safer investments? Obviously, the annuity question, that's always out there. So what, for somebody, maybe somebody who has had a financial advisor and they want to be talking to them about these things, they're not necessarily a retirement planner, they've been a growth advisor. Somebody's listening to this going, what should I go and ask my advisor about and see if they know about, can answer me questions on, or if I should be calling Ambush Financial?
Well, I'll tell you, Heather, even sometimes when a client will ask their current advisor about safer options in their portfolio that they could incorporate, sometimes the advisor will still push them into taking on more risk than they're comfortable with, believe it or not, because the firm may think that's the best thing for the client or in the client's best interest.
Okay.
They continue to take on more risk, even though the client might not be comfortable with it. If you're with a big box firm and you're with a big box firm that typically focuses on investment management, sometimes they use all stocks. And they may say, well, we're in international and small cap and large cap and domestic and this stock and that stock. And because of that, we're diversified, but they still might be in one asset class at stocks.
That's right.
Other firms, Heather, may say, well, you're concerned about risk. We are too. You're 65. You're retiring soon. We'll do stocks and bonds. Stocks and bonds. That's a traditional way to put together a retirement plan. Everything has its pro and con. When you talk about safer alternatives in a portfolio or safer instruments, bonds would certainly be part of that conversation. Treasuries, certain kinds of annuities, maybe structured notes, money market funds, CDs, treasuries. Those are the main instruments that, you know, you could either have some principal protection or all principal protection. But when you have a lot of safety, you just need to know that you're giving up some return for that safety. Right. We're not looking for growth on the whole portfolio.
That's right.
We're looking for safety over here and then growth over here.
It's about balancing
the balance, the two.
I think that it's such a valuable lesson for folks because we're taught our entire working years, our investment life, diversify. And for so many of us, because the lack of financial education that is an epidemic of its own in this country, we think, well, I am so diversified, Abe. Look at all of my different stocks that I own.
Right.
When you get to retirement, you need it's no longer just about diversifying stocks. It's about diversifying your entire portfolio. It's a totally different definition of diversification for retirement.
That's right. Yeah, we don't want to be too conservative because you could have 30 years in front of you in retirement.
Right.
We also certainly don't want to be too aggressive
where
you have the chance of losing 20, 30, 40% in a year. That's way too aggressive. So you need a happy medium between the two where a good portion is going to be set aside for growth with higher return potential, a smaller portion typically, or maybe a 50-50 split. Who knows what it is? It depends on that person. That's there for more safety, more protection, more limited returns, but that additional peace of mind too. It's that combination and that balance that is really key.
Diversification looks different in retirement. So ask yourself, are you truly diversified for the way you need to be for your future? If you have questions, if you have an advisor that maybe is not wanting to talk to you about safety in your retirement, you can always turn to Abbott Financial Services. They are here to help Abe and his entire team. TheRetirementKey.com is where to go to start the conversation. We also have links posted in the show notes. Don't forget, Abe is here to give you education. His book that he wrote and published, The Retirement Mountain, The 7 Steps to a Long-Lasting Retirement. It's just about 90 pages. There it is. There's your copy. It's just about 90 pages long, a real easy couple-hour read on the weekend to get some education and knowledge, get you going on this second phase of your financial life. If you want a free copy of the book, we give a free copy to everybody who comes in for an appointment for a review. You can also buy it on Amazon or download a free chapter. We've got all that information up again. It's theretirementkey.com. Click on the media tab. You will see links for the podcast, for the book, and all the other information there.